There's a number I want you to sit with for a second. $50,000. That's roughly what the tax office can legally take from your kid's inheritance, from money you already paid tax on once. If you never have one particular conversation before you turn 75, nobody sends you a warning letter about it, your super fund won't mention it in the welcome pack, and by the time most families find out, the money's already gone. That is just the first of 7 shocking things sitting in Australian law right now, completely legal, completely on the ATO's own website, that almost nobody over 60 ever uses. Not because they're complicated, and not because you need to be wealthy, simply because nobody ever sat them down and explained that they exist. If you want to protect your hard-earned wealth and make sure you never miss critical updates like this, hit that subscribe button right now and press the bell icon so you are always ahead of the system. I'm going to hand you all 7 shocking strategies today. What they are, who qualifies, and, this is the important part, the exact question to take to your accountant or advisor so it actually gets switched on, instead of sitting there unused for another year. Let's get into it. If you're over 67, you're not on the age pension, and your income sits under $101,105 as a single, or $161,768 as a couple combined, there's a good chance you already qualify for the Commonwealth Seniors Health Card, and most self-funded retirees have never applied for it. Here's what it actually does. Your prescriptions drop to around $7.70 a script, frozen until 2030. The Medicare safety net kicks in earlier, and depending on your state, you pick up discounts on electricity, council rates, car rego, sometimes public transport. Stack all that together, and most households are looking at well over $1,000 a year in savings, some considerably more. Now here's the bit that trips people up every single time. There is no assets test on this card. None. You can own your home outright. You can have a healthy investment portfolio. You can have a very comfortable super balance sitting there. This card doesn't care. It only looks at income, and money still sitting in super and accumulation phase doesn't count toward that income test at all. It's invisible to the test. I've watched this play out the same way more times than I can count. A self-funded couple in their late 60s drawing carefully from super who've never dealt with Centrelink in their lives, so they just assume concession cards are for pensioners, not for them. Their accountant lodges the return every year and nobody raises it. 6, 7, 8 years go by. Full price on medicine, full price on power, for nothing. One thing worth knowing. If your account-based pension started on or after January 2015, it does get counted under the deeming rules. So if you think you're close to the line, this is a 5-minute phone call. Call the Centrelink Older Australians line and ask a financial information service officer, based on my income and my pension balances, am I likely to qualify for the Commonwealth Seniors Health Card? Everyone in this country knows the standard tax-free threshold is $18,200. What almost nobody over 67 realizes is that theirs is considerably higher, closer to $35,000 for a single senior before you owe a cent. The mechanism is an offset called SAPTO, the Seniors and Pensioners Tax Offset. It comes straight off your tax bill, dollar for dollar, and it tapers out gradually rather than cutting off sharply. Here's the catch that catches people out. You don't need to be on the age pension to get it. If you're 67 or older, you meet the residency test, and your income falls within the limits, you qualify, even as a fully self-funded retiree who's never set foot inside a Centrelink office. The ATO applies it automatically at lodgement, but only if the right information actually makes it into your return. Click past the offset section doing your own return online, and it can simply never get claimed. Same story if a tax agent doesn't ask the right questions. I had a retiree come to me who'd been doing her own return for 3 years, around $32,000 in super pension income, a bit of bank interest, and paying roughly $2,000 a year in tax she genuinely didn't owe. Once SAPTO was applied properly, her bill went to zero. She amended the previous 2 years and got that money back too. Ask your tax agent this year, have you checked whether I'm entitled to SAPTO and whether any unused portion should transfer between me and my spouse? If you're on a part-age pension and still doing a little work, this one's for you. And it's one of the most misunderstood rules in the whole system. You've probably heard the headline version. The first $300 of fortnightly employment income doesn't count toward your pension income test. What most people never find out is what happens to that $300 when you don't use it. It doesn't disappear. It banks. Every fortnight you don't earn it, it rolls into what's called your work bonus income bank, up to a maximum of $11,800. New pensioners start with a one-off $4,000 credit already sitting in there. Picture someone who hasn't worked in a while. They could be sitting on $4,000 or $5,000 in that bank without knowing it exists. They pick up some casual work, earn well over $300 in a fortnight, and the bank absorbs it before the income test ever touches their pension. I've sat with people who were turning down work they genuinely wanted, terrified it would cost them their pension. When I showed them the balance already sitting in their income bank, waiting to be used, that look on their face stays with you. They'd been saying no for nothing. If you're self-employed, make sure Centrelink has the correct share of your business income recorded as coming from your own personal effort. Leave that field blank, and the work bonus simply won't apply. One caveat worth knowing, this only helps if it's the income test limiting your pension. If it's the assets test holding you back, the income bank won't shift your payment. That's your first three. All three of those you can act on this week. Most take one phone call. Now we move into the ones where the numbers get bigger, and the decisions carry a bit more weight. From the moment you turn 60, anything you pull out of a tax super fund, a lump sum, an account-based pension, a transition to retirement pension while you're still working, comes out completely tax-free. None of it counts as taxable income. None of it feeds into anything else the ATO calculates for you that year. Think about what that means if you're in your early 60s, still on a salary being taxed at 30 cents in the dollar. If part of your living costs comes from super instead of your salary or savings, you can genuinely reshape your entire tax outcome for the year. This one needs proper modeling. The right person for that is a licensed financial advisor. The question to bring them: given my salary, my tax bracket, and my super balance, would a transition to retirement pension or an account-based pension lower my overall tax? One detail worth flagging: earnings inside a transition to retirement account are still taxed at 15%. That rule changed back in 2017. So if any advice you've heard is older than that, it's out of date. If your total super balance was under $500,000 at the last 30th of June, you may be able to contribute far more than the standard $32,500 cap this year by using what's called carry forward, scooping up unused contribution room from the previous 5 financial years. This matters most if your super has gaps in it, years out of the workforce, running your own business and paying yourself in ways that didn't build super. Just a run of lean years. That unused room has been quietly stacking up the whole time. Someone who barely contributed for 4 or 5 years with a balance under that threshold could potentially put in $100,000 or more this year and claim the whole thing as a pre-tax deduction. That's a genuinely powerful move in a year. You've got a large taxable event to offset. Sold a business, sold an investment property, staring down a big capital gain. 2 conditions worth knowing. If you're between 67 and 74, you need to pass the work test to claim the deduction. 40 hours of paid work within any 30-day stretch during the contribution year, and you can check your own carry-forward balance right now. Log into MyGov, go to the ATO, then super, then information. The figure is sitting right there waiting. If you're 55 or older, you've owned your main home for at least 10 years, and you're thinking about selling, you can put up to $300,000 each from the sale into super, per person, so up to $600,000 for a couple. What makes this one different is that it sits completely outside the normal contribution caps, and there's no total super balance limit attached to it at all. Even someone already sitting on a large balance can still use it. 2 hard rules to respect. The contribution has to land within 90 days of settlement, and the ATO's Downsizer form needs to reach your fund at or before you make the contribution, not after. Get that order wrong, and it can be knocked back outright. If you're also eligible for the Bring Forward rule, you can stack up to another $390,000 in after-tax contributions on top, in the same year, per person. For a couple selling the family home, the amount you can shift into the tax-friendly super environment in one hit adds up very quickly. One real warning though. If you're anywhere near age pension territory, selling the home and moving that money into super can shift your assessable assets dramatically. That needs careful modeling before you sign anything. And here's the one I most want you to actually hear, because it's the one people find out about too late. Australia scrapped inheritance tax back in 1979. Most people know that. What almost nobody knows is there's an effective death tax living inside superannuation, and it activates the moment your super passes to your adult children. When super is paid out as a lump sum to a non-dependent, usually a grown financially independent son or daughter, the taxable component of it gets taxed at around 17%. That's 15% plus the Medicare levy. And for most Australians who built their super through a working life of concessional contributions, that taxable component is the bulk of the balance. So on a $500,000 balance that's mostly taxable component, Your kids could be facing a tax bill north of $50,000 on money you already spent decades building. The fix is completely legitimate, and it's called a recontribution strategy. Because withdrawals from 60 onward are tax-free, you withdraw a lump sum out of the taxable component and immediately recontribute it as an after-tax contribution, where it becomes tax-free component instead. Do that across a few years, staying inside your contribution caps, and you steadily convert money that would have been taxed on its way to your children into money that reaches them completely untouched. This isn't aggressive. It isn't a grey area. Advisors have used it for decades, and the ATO knows exactly how it works. It's simply what the legislation allows. And nobody's job is to volunteer it to you. Not your fund, not the ATO, not the product disclosure statement. Here's what makes it urgent. The cutoff is 75. It doesn't taper. It doesn't ease shut. On your 75th birthday, the door on these voluntary after-tax contributions closes. Full stop. If you're 68, you've got time to plan this properly. If you're 73, this is a conversation to have this month, not next year. The question to bring to a licensed financial advisor: what's my current taxable and tax-free component split, and would a recontribution strategy make sense given my age, my balance, and who my super is going to? 30 minutes. One appointment. For some families, that single conversation is worth tens of thousands of dollars kept where it belongs. Here's the thread running through all 7 of these. None of it is hidden. Every single one is sitting on the ATO's website, in the legislation, in Services Australia's own guides right now. The information has never been secret. It's just never reached the people it's written for. And honestly, there's very little incentive in the system for that to change. So don't try to tackle all 7 this week. One thing done properly beats 7 things half understood. Here's where to start. Log into MyGov, go to the ATO, then Super, then Information. Check your total super balance because it affects several of these. While you're there, if it's under $500,000, check your carry forward number too. Then call your super fund and ask for your current taxable and tax-free component breakdown. That's not financial advice. It's just a factual question about your own account. Write both numbers down and take them to a registered tax agent or a licensed financial advisor. That conversation with those 2 numbers in hand is where the real money is. One last thing before you go. Everything you've just heard is general information, not personal advice. Your situation has details none of this can see, especially for the super and estate side. Get a qualified professional looking at your actual numbers before you act. These provisions were written into the law for every single Australian. Most people simply never get told they exist. If this saved you from being one of them, make sure to hit that subscribe button, leave it a like, turn notifications on, and I'll see you in the next one.